The infinite banking concept simplified. What is this infinite banking concept? Well, look, let's consider the words, okay? Infinite. It's not finite. It's unlimited. It's limitless. It's infinite. And then banking. Well, what is banking? Webster says it's loans, loan repayments, deposits, withdrawals, checking account, savings account. It's the movement of money. Right? And then concept. A concept is nothing more than an abstract idea. So what we're going to do in this video is bring clarity to this concept and put form to this abstract idea. All right, well, look, let's consider what's really going on in the big wide world. All right, we're all surrounded by noise, and it's relentless. Right? The noise that we live in today, it's relentless. And some of the worst noise is in the financial world. So just cut through some of the noise, okay? Cut through the noise and let's get to the clarity, right? Well, look, in the financial world, we're all taught to work hard, save our money, cut our lifestyle if you have to, get a tax deduction while you're saving, which that typically that savings to get a tax deduction is winding up in a qualified retirement plan, a 401k, an IRA, a 403b, or whatever it is. Well, there is a difference between savings and investing. Investing has an element of risk, right? The risk of loss. So if you consider the definition of risk, maybe you'd agree with me that a definition of risk could be the probability of loss, right? Okay. Well, if that's true, and I believe it is, think about this. The financial world tells you to expose your money to the probability of loss, and the longer you do that, the better the outcome will be for you. Maybe, maybe not. There may be a better way. But let's consider what savings actually is, right? And the savings rate in America today is appallingly low. It's below 4%, right? You got to spend the money as fast as you get it because inflation's devastating the value of the dollar. I digress. Consider what savings actually is. You have an income. Your expenses should be lower than your income. That difference is your capital, your money. And so you should save it, not to spend it now, but to save it for a future purpose, whether it's spending, investing, or whatever it may be. Okay. Now, savings should not contain an element of risk, right? Risk of loss, right? As a matter of fact, it's almost required. It's highly preferred not to have any risk to your savings. Okay, so there's a difference between savings and investing. When you put your money into an IRA, qualified plan, 403b, 401k, IRA, typically that winds up going into the stock market, some form or fashion. So then is it really saving for retirement, or is it investing for retirement? Okay, well, how much of the element of risk do you want in your savings? I'm just saying there's a distinction between savings and investing. Should you have investments? Maybe so, right? Should you have savings? Yes, maybe so. Only if you want to have the ability to spend money in the future, right? Or take on a worthy goal or project, whatever it may be. So if you put your money into a qualified retirement plan, an IRA, 401k, 403b, etc., you've effectively separated yourself from your capital, right? Because it's put up and put away for that future purpose of retirement income. So now if the majority of your money is going there, right, you're separating yourself from the majority of your capital. So if you don't have access to your capital to make major purchases, for example, whatever they may be, automobiles, vacations, education. If you don't have access to your capital, then you're beholden to someone else, right? And having access to their capital, having the ability to access their capital. Well, guess what? Who controls that access? They do, right? They're going to tell you how much you can have, how much you can access, how you're going to access it, when you're going to pay it back, and at what rate, right? I mean, they're a gatekeeper and a toll taker, right? Your capital, your money is in long-term, illiquid liquidity, the access to money, cash or cash equivalents, right? Your money is in a long-term investment program or savings program. You've separated yourself from that capital. So if you need capital, you're going to be beholden to someone else, and they're going to control your access. Okay, think about that. Now, while you're saving or investing for some long time in the future project, retirement in this case or this example, you're making purchases every day, year in and year out, some larger than others. But I want to talk about or focus on the major purchases, the automobiles. How many automobiles have you driven since you have been driving? And how many are you going to drive for the rest of your life? This is just one example of one major purchase that we all make over and over and over. I don't care if you leased a car, you pay cash for it, or you formally finance. That's a cash flow going through your personal economy. All right? Okay. So, well, James, I don't pay interest, and I don't mind, I have the money, I'm going to pay cash. So, well, if you think about that, you have to save up cash to make a cash purchase. And then as soon as you make that cash purchase, you have to start saving again to make the next cash purchase, right? They're still cash flows. You're accumulating capital and then spending it. Okay, well, when you do that, you are interrupting the compounding of your savings. Every time you put it into a savings vehicle, whatever it is, and it starts growing, and then you pull it out to make a major purchase, it's not going to earn any interest or dividends for you forever. Now, you get the purchase, you get to enjoy whatever it is you purchase, but then you have to start saving again, over and over and over and over. And just think about the major purchases you're making in your life. All right, it becomes, you're making a lot of purchases, all I'm saying. So look, you can make your savings, your money, your capital earn interest and dividends forever, tax deferred, accessible, tax-free, with this infinite banking concept. All right, so we're going to talk about the infinite banking concept. I've kind of talked about what's going on in the big wide world where most people save their money. Look, IBC uses high cash value, dividend paying, whole life insurance issued by a mutual company. Now, every one of those are important. So you may have some homework to do to discover the importance of what I just said. All right, now you've got to be able to get past the word life insurance. You probably can if you're 40-ish or younger, if you're 40-ish or above. I'm not talking about the life insurance that just came to your mind when I mentioned the word life insurance. Okay, I'm not talking about your grandfather's life insurance, although there's nothing wrong with life insurance. As a matter of fact, life insurance is it's a phenomenal financial tool. All right. But what we're talking about with the infinite banking concept is a uniquely structured, particular type of life insurance. Dividend paying whole life insurance issued by a mutual company, now structured for cash. So the focus isn't on the death benefit, the focus is on the cash value, the cash accumulation. Now, why life insurance, right? You can bank with anything, but look, life insurance has all the characteristics that you need to get into the banking, quote unquote banking, right? But let's before we get into banking, let's talk about life insurance. Did you know life insurance is a private asset? And I'm talking about permanent life insurance. It's a private asset. It's a private contract between me and a private entity, right? It's a protected asset, right? It's a non-countable asset in most states. You own it, you control it, right? Just like your automobile, if you buy an automobile, that's your asset, you own it, you control it. Life insurance is the same way, okay? But it's also an appreciating asset. It goes up in value. The death benefit increases, the cash values increase, and you can make the dividend increase as well. 24 hours a day, it's growing, getting more and more valuable. It's appreciating. 7 days a week, 365 days a year, even on weekends and holidays. Do you know the stock market's closed on weekends and holidays, right? Life insurance is compounding and accumulating interest and dividends, tax-free, accessible, tax-free forever. That's pretty powerful. Okay, now it's also a cash flowing asset. You know, it can produce a positive cash flow that's preferentially tax treated, so it can create this passive stream of income. Passive. I didn't have to do anything for it. You know, I have to work. I have to exchange my time, talents, and abilities, right? It can produce a passive stream of preferentially tax-treated income. That's powerful. It's liquid. You can access the value that you have in a dividend-paying life insurance. You can do that through loans or withdrawals. And then it has a deferred benefit, right? You know, someday you're going to die. We're all going to die. And when you do, and you own life insurance, permanent life insurance, there's a net death benefit that's passing to your heirs or whomever you want it to pass to in a tax-efficient way, tax-free. All right, so life insurance is a real asset, right? It is a private asset. It's a protected asset, right? It's an appreciating asset, and it's a cash flowing asset, and it has a deferred benefit. Now, as a side note, if you look at it, let's look at the real estate investing or, real estate portfolios. Think about this for a minute. The reason people buy real estate, it's private property. They own it. They control it. It's preferentially tax treated. It appreciates. It throws off a cash flow. And then there's a deferred benefit. When you sell that property, if it's gone up in value, you're cashing out. Right? Life insurance has very similar characteristics. And in fact, when you marry the real estate portfolio and investing with the infinite banking concept, you have almost reached financial nirvana. Okay? Now, look, these are bold statements, so I encourage you to continue your education in our learning center to see if this makes sense for you and your family. Sometimes it will, and sometimes it won't. Okay, just don't throw the baby out with the bathwater. You know, most people, their perception of life insurance is based on someone else's misconception. So I'm just encouraging you to discover the infinite banking concept for yourself. Okay? Now, we can show you how to spend the death benefit while you're alive today. If I back up a little bit, we're talking about life insurance. Life insurance has always been used in the financial world for the death benefit, and the focus has been on the death benefit. But with the infinite banking concept, we're focusing on the cash accumulation. Yep, you can't buy life insurance without a death benefit. It doesn't come any other way, okay? So once your need for death benefit is solved, and if you have a need for death benefit, you should solve that. Once that is solved, then life insurance should be used for cash accumulation, the cash value, all right? Okay, so whenever you consider all of the characteristics of life insurance structured the way I'm talking about, issued by the particular companies that I'm talking about with the infinite banking concept, what you have operates like a pre-engineered tax-free trust, okay? Now, let's consider some types of life insurance, right? I mentioned the word life insurance and I use permanent. The industry is just filled with industry terminology, right? Some of it's pretty straightforward and some of it can be a little confusing. And there's just a lot of words that, every industry has its own language almost. So let me share with you what I'm not talking about. There are all kinds of life insurance policies out there. When it comes to the infinite banking concept, I am speaking very specifically about dividend-paying whole life insurance issued by mutual companies structured for cash. That's about the third time I've said that in this short video, right? That's the first paradigm shift in thinking, though, is a structure, and then we're focused on the cash value, not the death benefit. We're trying to really get as much money into the policy as possible with the least amount of death benefit while maintaining the tax treatment of life insurance. This is nothing new with life insurance, right? What is new is the scale that Nelson discovered in the 80s. Right, and his story is in the first part, the first section of his first book, Becoming Your Own Banker. Right, so buy the book, let him tell you the genesis of his discovery. It's powerful and it's well worth reading. So I encourage you to get that book and read it. We're not talking about universal life insurance. We're not talking about variable universal life insurance, and we're not talking about this god-awful indexed universal life or equity indexed universal life, right? That's the latest product that the life insurance industry has foisted on the unsuspecting American public. Now let's look at this. Life insurance, universal life insurance has been around for over 400 years. All right, or the concept of insurance has been around well over 400 years. Life insurance has been around for over 200 years. Okay. Universal life insurance was created in the 80s by the insurance companies. That's back when interest rates were 10 and 12%, right? So there's really kind of two parts to a universal life policy. There's the death benefit. The cost of that death benefit continually increases. It compounds over time. The closer you get to mortality, graduation, the higher that cost of insurance is. And then it's segmented, all contained into one policy. There's really two parts, the death benefit and then the side account, or the vehicle that is used to accumulate interest, right? And universal life insurance was designed in the 80s when interest rates were very high. Those policies have all but imploded today. This is 2018, right? Now the insurance companies, they came up with variable universal life in the 90s. Wonder why? Stock market's going like crazy. Hey, let's use, some sub-accounts that look like mutual funds to get the interest credited. Oh, those work out pretty well when the market's up. Well, what's the market going to be next week, next month, next year? And will it compensate or overcome that ever-increasing cost of insurance of the death benefit? In the last several years, the insurance companies have created equity indexed universal life, right? They've dropped the equity on a lot of them. Now it's just indexed universal life. So they're using an index or a series of indices to get the interest crediting. And it's combined with the internal cost of the death benefit, the cost of insurance that goes up every day. 24 hours a day, 7 days a week, 365 days a year. And the older you get, the cost of that death benefit increases. It's an exponential curve. Most of those come unwound typically when somebody is in their 70s, right? They discover, oh, this might not work out like I thought. And then it's typically too late to correct it, right? So I would encourage you to, before you take any action of any kind, right? Take the action of learning. You're the best investment that you have. You cannot invest enough in yourself. And I'm encouraging you to invest in yourself through education, right? Learn about this concept. Learn enough to make a good decision either way, whether it's good for you or not good for you. Take the time to do your research and your homework, and you vet it for you, okay? All right, so the life insurance companies, they got it wrong with universal life in the 80s, right? Strike two, they got it wrong again in the 90s with variable universal life. And guess what? They got it wrong again with indexed universal life. Strike three. Okay, now look, my encouragement is to do your homework, okay? And I think a good and worthy resource is our learning center at bankingwithlife.com. Go there and research more about universal life policies. Research and discover more about the infinite banking concept. How do you become your own banker? And is it really worth your time, effort, and energy to do so? Okay? You decide for yourself. Now look, the type of insurance And the structure of the policy is extremely important when it comes to the infinite banking concept. Once you have vetted the information yourself and it makes sense to you, or you think it makes sense to you, and you start a policy, you need a good coach, right? You need to work with somebody who knows what they're doing, knows how to structure a policy, knows the correct insurance company to choose. And this is not esoteric. The information is out there. Right? So I don't have some 5,000-year Dead Sea Scroll secret, right? I don't have some esoteric hidden knowledge. No, this is all above board. It's well within the law. It's not a tax scheme. The insurance companies even know what's going on, right? So this is not hidden information. You can find this information, okay? All right. But once you have structured a policy and you're paying premiums, you're putting money into the policy in the form of premium, right? And the more you do that, the bigger the pool that you've created of capital becomes. When you put money in the policy that's structured for cash, all you're doing is creating a pool of capital that you own and control. And the more you put in, the better it gets for you. The more capital you have access to, the more opportunities you can take advantage of. All right? And I'm not saying that you have to go out and look for things to put your capital to work at. I'm not saying that at all. But you are financing automobiles. Right? The average family spends well over $1 million just driving cars. And I'm not talking about a big family. I'm talking about a husband and a wife. All right? The question here would be, how much of that money would you like to retain? Okay? Yeah, discover how you can do that with the infinite banking concept, because you can become your own banker just financing automobiles. Very simple. And now, once you put money into the policy, you're creating a pool of capital. Right? That pool of capital you own and control. You can access that capital collaterally to finance everything that you were going to finance anyway. And I'm just talking about automobiles, but you're financing education, vacation, retirement income, passive income in retirement. All right? Now, when you create a pool of capital, right, and when you put money in, it's going to do very well. Right, it's going to go up. It's an appreciating asset. Right? It's a cash flowing asset. It's going to do very well. So you can access that capital collaterally through loans. So you're not interrupting that compounding by taking money out through withdrawals, although you can do that if you want. A better way may be through loans, right? You're just collateralizing the cash value. Now you're controlling that loan. Are you going to pay the insurance company interest? Of course you are. Okay, of course you are. You're not going to borrow money anywhere without paying interest on it. Okay, and so your capital has value, so practice honest banking. Not only pay the insurance company interest, but pay yourself the market rate of interest. It's no big deal. And whenever you do that, let me see, your pool of capital goes up, your future dividends go up, your death benefit goes up, right? More opportunities show up. When you're in the position of owning capital, right, you've gone through the effort, the time, and the energy to accumulate capital. It's capital formation. That's the basics of fundamental economics. Capital formation. This is a very good way to accumulate capital. Capital formation. You accumulate that capital, right? And the more you use it to finance things that you are going to finance anyway, which is every major purchase, the bigger your numbers get. The death benefit goes up. Yeah, well, we're not interested in that. Okay, I'll show you how to spend the death benefit today. Okay? The cash values go up. The interest goes up. Why? Well, because you put more capital in. The dividends go up. Why? Because you put more capital in. And you've never had too much capital. You've never had access to too much capital. You can't put enough money in life insurance policies structured this way. My opinion, right? Now, becoming your own banker is really just that simple. Capital formation in an entity that you own and control that's structured for cash, that has all of these wonderful characteristics that you can use to make your pool of capital bigger and better. Cut through some of the BS that exists out there in the big wide world and discover the infinite banking concept for yourself. Becoming Your Own Banker, the book, Nelson's first book, in our learning center at bankingwithlife.com. The Nelson Nash Institute is a great resource, right? It's infinitebanking.org. You know, it's not that pirated account.com. It's infinitebanking.org, right? And just cut through some of the BS that exists in the big wide world, okay? And then look, connect with someone who knows what they're doing, who has done this, that are not going to practice on you, right? Someone who's done it, someone who's doing it, and someone who knows how to do it, okay? Someone that can structure the policy correctly for you, exactly where you're at in your financial life. And we can do that in my office, all right? We can structure the correct policy for you, exactly where you're at in your current condition and situation, and you can grow into the policy. You can structure a policy correctly for whatever it is you're doing in your financial world, right? I mean, I've practiced banking. My name's James Nether. I didn't even introduce myself, right? I have practiced the infinite banking concept for over 13 years. I've been in the financial world for over 27 years. I know I don't look that old, right? I am, but look, what I'm saying is we know how to practice banking. We know how to teach our clients how to bank. It's an educational process, but it's not that big deal. It's not that big a deal, right? Our office exists to service our clients, and you should be one, right? You should be our client. Okay, so go to the website, keep kicking around and discovering, reach out to us, send us an email, register for a webinar, go to our learning center, and get into the modules that we have there. We've got great content on the website, and we're adding more and more to it every day. All right. Listen, thanks for spending this time with me. I can't wait to meet you. I can't wait to help you, and I wish you the very best.